Good afternoon, everyone. On behalf of CFO Capital and Colliers Hotels, I'd like to welcome you to the first in a series of webinars we will be hosting on the state of the Canadian hotel market. Just over a week ago, we set out to organize this session and are pleased to see that we have hit our capacity at over 1,000 people register and hopefully all logged in and able to participate. The spread of COVID and the collapse in oil prices has had a catastrophic consequence on the travel, leisure, and hospitality industries. The past couple of weeks have created a strong need to connect against a backdrop of increasing isolation. To that end, we've assembled a panel of industry participants who are not only experts in their respective fields, but have by default become experts in crisis management. Through our discussions today, we're hoping that their experiences will benefit the broader industry as we navigate through these turbulent times. Joining us today are Brian Flood, Kerry Russell, Deepak Ruparel, George Kashuka, Kenny Gibson, and my co-host Mark Kay. My name is Alan Pirani, and I'd like to begin the discussion this afternoon with Kerry. If you are able to give us a quick synopsis of what's the real-time data on hotel market performance, and also take a look at past events that caused disruption in the market. Kerry?
Sure. Thank you, Alan. And first off, Alan, Mark, thank you so much for coordinating this. I think obviously just by the number of registrants that you got in such a short amount of time, people are really seeking information. So this is a great forum, and I hope that it'll be informative today. So I can say that, after a run of 10 years of giving market updates and sitting on panels similar to this, this is probably the most difficult update that I hope ever to have to share, because the numbers are just catastrophic. We really started to see the impacts of COVID in the Canadian numbers starting the week of March the 7th. Occupancy was down that week about 5.2%. The following week, March the 14th, we were down another 24% in terms of occupancy. The week ending March the 21st, occupancy dropped another 65%, RevPAR dropped 71%. So sitting at the end of the week of March the 21st, nationwide, the occupancy in the country was 21%. For the week ending March the 28th, the numbers will come out on Wednesday. Smith Travel Research is consistent about putting their deck out. And the expectation is that last week's occupancy will be around 13%. Hearing what the outlook is from the larger hotel players in the market, the month of April will likely be 10% occupancy or possibly even slightly below that. We're seeing a slate of hotels closing. Specific numbers aren't available at this point, but anecdotally, I know 54 hotels in Montreal have closed. So I'm sure we've got well over 100 properties in Canada that are closed right now and not operating. So, when we go through cycles like this, we look back to previous cycles to see if we can draw any comparisons. And we've heard experts in the industry talk and say this is like the economic crisis and SARS combined. So just to give you a sense of what SARS looked like, and Toronto was the hardest hit area for SARS when it happened in 2003. And the lowest occupancy recorded in Toronto that year was in the month of April 2003, and it was 42.4% occupancy. So when we're talking nationwide occupancy at 10% for the month of April, there's just no comparison to this. In 2001, the effects of 9/11 caused a national RevPAR contraction of 2%. SARS in 2003 caused a national contraction of RevPAR of 8.9%. The economic crisis in 2009 was a 10.7% contraction in RevPAR. And at this point, it's anyone's guess on where we end up this year in terms of RevPAR, but we're seeing numbers and internally bantering around numbers in the range of 35 to 40% declines in RevPAR this year. So it's pretty dramatic. It's not the way you necessarily want to kick off a conversation, but I think it's the reality of the situation. And I'll pass it back to you, Alan, to start the conversation.
Great, thank you, Kerry. Appreciate that. We have with us a diverse and experienced panel that represents the broader hotel community. So the owners on this panel own everything from luxury and first-class full-service hotels to focused service urban and suburban hotels to limited service and in secondary and tertiary markets. And not to forget resort properties. I'd like to ask Deepak, Kenny, and George to shed some light on where the first signs for each of you came. Perhaps I'll start with Deepak.
Namaste, Alam, and thank you again for arranging this webinar, and hope everyone's safe and well. We actually started looking at this issue almost 6 months ago, not about the coronavirus, but maybe a potential downturn in the market. So we were starting to plan maybe having a reduced occupancy rate almost 3 to 6 months ago. Then when we saw what was happening in China in January, and then jumping over to Europe in February, on March 1, we convened an emergency call with all my team leaders to say this thing is moving quickly, we need to be ready for a response. So never did we imagine it was going to go down to this level. So realistically, we had planned for some slowdown, but never a slowdown like this. So March 1 was probably the date when we thought that this is going to impact us dramatically. So that's probably as good as I can give you dates.
Great, thank you. Kenny, would you like to share your thoughts?
Sure, I agree with Dee. We started looking at the fourth quarter last year, and to echo what Dee indicated, we saw that there was going to be, or we thought there was going to be some slowdown, not a decline, but a slowdown in the growth in 2020 and possibly 2021. We, unfortunately, as Carrie had indicated before, we learned some lessons from SARS. So when we saw things that were getting worse in China in mid-January, we reached out to our suppliers for things like hand sanitizer and the stands to put that in for all of our hotels, masks, gloves, and those types of things. And one of the leading indicators for us, our suppliers indicated that those items were on back order. So we started thinking about the impact of this kind of mid to late January.
Great, thank you. George, your thoughts on this?
Thanks, Alan. In addition to what Deepak and Kenny have said, we actually were planning for a downturn in 2020 as part of our business planning cycle. We saw a slowdown in business in Q4 and thought that we needed to plan for a recession in 2020. So we did start that planning, and a lot of it is coming very, very handy with what we're facing now. We did, as I mentioned, we did see a slowdown in Q4 last year, but in fact, January and February, we exceeded our budgets, and the year actually started very, very well. Similar timeline to Kenny and Deepak, we had many meetings very early on this topic, and had our general managers conference scheduled for Winnipeg in the second week of April. We reached out to our general managers and canceled that conference right at the beginning of March. And then we actually put a plan in place for all of our corporate office people to have laptops, VPN access to our networks, loaded Microsoft Teams on everybody's computer to facilitate remote meetings. And we rolled that out and actually closed our office before ordering to do so more than 2 weeks ago to coincide with the school closing. So we decided to close our office as well because many people have small children and needed to be home in any event. So we actually, I know we're going to get into a chat about lenders, but we actually communicated with all of our lenders 2 weeks ago today on March the 17th to give them an update of what was going on and to ask for some concessions, which we'll talk about shortly. Alan?
Okay. Right, we're going to get back into a discussion on how you dealt with operational matters and rationalizing what hotels stayed open. But you touched on lenders, and perhaps this is an opportune time to have Mark. Mark, I know you've been in contact with all your hotel lending institutions that you've been working with. How have they reacted to COVID?
It was great to see how lenders across Canada have been very supportive of the hotel industry. Majority of the institutions have been providing both principal and interest relief for a minimum of 3 months. The balance of the institutions have been providing 3 to 6 months of interest only, and then reassess the situation down the road. We get some further clarity in the market, which will definitely help and ease the working capital constraints of hoteliers. What's very interesting is dealing with the current acquisitions that are in place, as well as the construction loans and refinancing that we have approvals on. I would say majority of the institutions across Canada are honoring the commitment letters that are in hand, as well as the scheduled closing dates. Furthermore, what's very interesting is some of the institutions are providing interest-only relief for the term loans the day of closing, knowing that some of the hotels are operating at 5 to 10% or may be closed. So they're recognizing this anomaly during this time frame, which is very supportive.
Great, thank you. And Kenny, perhaps you and Deepak and George, if you can just give us a sense of how you, dealt with your lenders and what the reaction was, to the extent that you can share.
I'm clearly echoing what George was saying. First thing first, what we did was try and contain the damage and preserve liquidity. That was our main number one goal. And we looked at every opportunity to see what we could do with each asset, where they were located, and what we had to do. Clearly, the message was we're going to be down into the 5 to 10% occupancy, so it didn't make sense to keep it open. It didn't make sense to shut it down. We did a rationalization on all of the assets and had to, unfortunately, lay off a lot of people, including our head office. Having arrested the problem and contained the problem, then we decided, okay, what do we do next? We then went into a mode of making sure that our liquidity was preserved. So we looked at every relationship we had, whether it's a lender, supplier, Rogers Cable TV, or whoever. What can we do to suspend services? So we got that contained. And then, of course, we then did our budgets for the lenders to show that if we're shut down for 2 months and then operate for the next 12 months at 50% occupancy, what does that look like on a go-forward basis? Having done that, we communicate that with our lenders in an open, transparent way so that they understand, because they themselves don't know what the next outlook is going to be. So giving them enough information so that they can make their decisions on, and then obviously they're waiting for government programs to see what they're doing. So it was first was to arrest and understand what we had. Second was to contain our liquidity. And then third is to communicate effectively to all our stakeholders, including franchise companies, management companies, and different partners. Alan?
Kenny, did you want to add anything to that?
Yeah, Dee hit the nail on the head. During these difficult times, and we saw it during 9/11 and during SARS, you can't over communicate with the stakeholders that are part of your business, whether it be the lenders, the brands, the management companies, the suppliers. So the communication part is most important, at least for us. We started talking about, and I had discussions with Mark probably 5 or 6 weeks ago about this potential downturn in business because of the COVID-19. And we started thinking about how we were going to communicate with our lenders 5 or 6 weeks ago. So I fully agree with Dee all the way through.
Great, thank you. George, anything to add on this? I would like to.
Sure.
Yeah.
Sure. I'll keep my comments just specifically related to debt and lenders. And I can tell you that since we started communicating with our lenders, we have received nothing but cooperation and support. We asked for a 3-month principal holiday. We thought it was very appropriate to not ask for more than what we knew we needed at the time. I can tell you also that I received the first approval from a lender of a 3-month principal holiday within 5 minutes of sending him an email 2 weeks ago. Many of our lenders have already approved this. Others, it's still in process. We expect 100% approval of this ask, which we think is appropriate and reasonable in the circumstances. We've had one lender approved for 6 months, despite asking for 3. We've had another approved for 4 as a matter of policy. We've had one lender give us an option of 3 months a principal or 3 months principal and interest, but with different payback timeframes. And we also have some maturities of debt in Q3 and Q4 this year. Those lenders have, without even being asked, offered reasonable the short-term extensions to get us into early 2020, which we really appreciated. Our goal in dealing with our lenders and my hope for the industry is that we not only survive this crisis, but that we ultimately keep all of our lenders whole. Proving that this industry can withstand the most severe operating conditions that any of us have ever seen, and hoping to give lenders the confidence to stay lending in our asset class.
Alan, if I may add, I think I want to echo what Georgia said. The lenders have been absolutely incredible to deal with. So they have gone and understand the issues and they've been very forthcoming with different options available, whether it's 3 months, 6 months interest, no interest principal, case by case, property by property, they've been able to react very quickly. And I must say that the Canadian banks have done a great job of that.
That's great. Actually, one of the things I should mention for participants is that we have a feature where you can ask questions, and I actually just pulled up one that I think is relevant to bring up now. And this is about secondary lenders, and perhaps Mark, you may be able to shed some light on this. The question is, are secondary lenders offering mortgage postponements? And I believe this question is specific to, is outside of the big six. What are you finding those lenders doing?
Yeah, I think there's two different categories of secondary lenders. We're looking at secondary lenders, meaning B institutions, some of the credit unions, etc. They are offering both the principal and interest postponements. When it comes to private lending or the mix of mortgage investment corps, that's a different case. I mean, you're already starting on bridge loans at an interest only for a couple of years. So the challenges are, it's a very case-by-case basis. Can you postpone the interest? So the feedback from them is they're going to look at a case-by-case basis, and I'm referencing again the mortgage investment corps and the private, if they can, let's say, postpone the interest for a few months.
Okay, Brian, we haven't heard from you, and I'm sure your phone's been ringing off the hook. You and Kerry both on lenders reaching out just on valuation. Broadly, just wanted to get your thoughts on how you're dealing with that.
Sure. Thanks, Alan, and like everyone else, thank you for you and Mark for hosting this. I think it's really important at this time. So I guess after all the commentary, I get to put a bow on top of this. So in some respects, but yeah, I mean, a very challenging time. I mean, as Kerry outlined, this is unprecedented. Both how quickly it happened and the kind of depths to which the numbers have fallen. But I think it's important to remember, though, that outside some of the challenges that we were seeing in some of the resource markets, this isn't this hasn't really been caused by weak economic conditions, and in fact, up until a couple of weeks ago, we were coming out of several years of unprecedented record performance and record profits in the industry. So I think it's important to sort of keep that in mind. Notwithstanding what's happened in the last 2 or 3 weeks, I still think that the mid and long-term prospects for the industry as a whole, I think, are still very positive. And the reason I mention that is because really the value of hotels is really driven by the long-term performance of the property, and not just what happens in the short term. And so really the value of a hotel asset is really the performance of that property over an investment horizon. So I think we have to sort of keep that in mind. In terms of how we're looking at properties, as you know, we typically value these through an income approach, direct capitalization, or discounted cash flow. A direct capitalization type of approach just doesn't work. I mean, you can't look at current or year one earnings given what's happened, but I think certainly using a discounted cash flow is appropriate, particularly when you have variances or changes in income. So right now, I think it is appropriate to make adjustments to 2020 forecasts. Obviously, I mean, this is going to be a challenging year. A lot of hotels will have very little, if any, income or perhaps even negative. But going into 21 and beyond, I think we'll see recovery. And, you know, I think within a year or two, I think we'll be back where we were. When we're looking at discounted cash flow, I mean, if you do lose a year of income, I mean, that really only accounts for about 5 or 6% of the overall value. So I think it's important to keep that in mind. We haven't seen any changes in investment parameters at this point, and that's consistent with what we're seeing in other asset classes. What some of our colleagues are doing in the other asset classes is they're beginning to change the Q2, Q3 cash flow forecasts, and I think that would be appropriate in the hotel sector as well. So I think if you're adjusting your year one cash flows, you're de-risking that cash flow. So I don't think you really need to make adjustments to investment parameters at this point. Depending on the length of the recovery and if there's any underlying economic issues that come out of this, those parameters may change down the road, but at this point, we don't see it. So I think as well, and I mean, Carrie can certainly add to this, but you know, I think there's good potential here for a V-shaped recovery. I know talking to some of my colleagues overseas and in the US, you know, there's lots of anecdotal evidence of new business being booked into the fall and next year. And as well, too, if you consider all of the events that have been canceled, you know, in the last few weeks, a lot of those are being rescheduled for the fall. I know my own daughter's wedding actually has been, you know, changed from April to October. The hotel conference was rebooked to October. So I think there could be potentially a lot of pent-up demand, provided that the, you know, virus is under control or a little more under control. So I think we could see a quicker recovery, not unlike what we saw after SARS, although that was a much smaller scale event. So in summary, I think you know, we will see some erosion in value, but that's largely based on portfolio here. In the mid to long term, I think the prospects are still very good, and so I think that, you know, any loss in value, I think will be fairly contained.
Yeah, one thing I would add to that is that, you know, if you are at a point where you need to have your hotel appraised as you're working through or coming out of this cycle, stabilized values are gonna be relevant to owners and lenders. So what does that recovery start to model out like, and what does that look like in terms of the stabilized value? Because you know, at this point, SARS was a fairly quick recovery. And people got traveling again. It's more what is the economic side of this, and what does it do to the economy? If you know, the virus is contained sooner than later, and the economic damage to the whole economy or the global economy is minimized, I think we recover quickly than if we have major economic damage around this.
So, Alan, if I could add to that a little bit. I mean, during SARS, I think we learned a lesson. Many hoteliers started trading on rate, and I think the occupancy recovered much quicker than the rate. The rate was 12 to 18 months to recover. So I think one of the things that we're doing is we're not trading on rate, and I think that will help stabilize the income as occupancies improve.
Yeah, the first 2 weeks of the downturn, there was almost no movement on rate. Last week, or the week ending March 21st that we have data for, rate was down 17% for the country. So, you know, there's no way to stimulate demand based on rate in this environment. So there's really no reason to drop rate. But there are some good indications coming out from some of the big management companies that the groups that are being rebooked or booked into next year, there's not a lot of discounting on rate. So they're not trying to secure future business based on rate. Which is positive, because I agree with Kenny. It takes a long time to get rate back.
Right. Thanks, Carrie. So I just want to shift the discussion to, and I know a number of you are actively involved with the Hotel Association of Canada. There are a couple of questions coming out regarding some of the measures to help liquidity. Kenny, George, whoever wants to start this discussion off, I think it'd be worthwhile for the participants to understand a little bit about some of the things that HAC has been working on and how successful they've been to date.
Well,
go ahead.
Sorry, I can speak, from our perspective. We've been in close contact with Susie Granal, who's the president of HAC. And folks, I'll tell you that there's not a louder voice in the industry than the Hotel Association of Canada. They have been very active in being first in line for some of the relief programs with regard to taxes, to some degree, some debt relief, some employee relief. So the association has been very, very helpful to us.
George, you had something to add?
Yeah, I'll just jump in here. It's not really association related, but I think the biggest and the most appropriate subsidy was announced yesterday by the federal government, and it may change hotel closures versus not closure decisions, and also help out with head office staffing. And that's the 75% wage supplement by the federal government that was announced yesterday morning. And that is 75% up to an annual salary of $58,700. So that's up to $847 per week per employee that you keep employed during this crisis, provided that your business is down by 30%. And so the hotel industry is going to qualify for this, big and small companies alike. And I think it's not only appropriate, it's hugely beneficial to our industry, this program. And I think it's going to benefit all of us.
It's great. George, you touched on hotel closures, and I know we're jumping around a bit here, but there are a number of questions that are coming around through the session today regarding the decision-making on shutting down hotels. And I know each one of you have gone through that exercise. Dee, can I ask you to share your thoughts on some of the things that you thought about, your organization thought about when you were thinking about shutting down hotels? What are the pros and cons?
I mean, clearly, what we're looking at is there sufficient business to cover the payroll? We're not worried about fixed costs because they are there, going to be there. So if a hotel is managing to cover payroll related, whether it's for 5 people or 7 people, and there's enough revenues to justify that, we tend to keep it open. But given the current announcement by the government of 75% wages, it changes that equation. So likely to shut down will be less. But keep in mind that we did a portfolio calculation. It's costing us approximately $1,000 per room per month whilst occupants are under 10%. So we have to budget that liquidity going for the next 45, maybe 60, maybe 90 days. So that number is pretty consistent with most of the portfolio, unless you happen to be a big cruise ship or a big hotel or a big box. That number is probably closer to $1,400, $1,500 per room per month to carry. So liquidity is very critical. So hopefully with the government programs, we can maybe mitigate that somewhat, but deferring the property taxes and deferring the principal, that number may come down to $700, $800 or $600 per month per room in your portfolio. So we are focused on looking at numbers from that point of view. Clearly the deferral of capital with the banks and deferral of property taxes does help tremendously to conserve your liquidity. And now with the 75% wage subsidy, that should hopefully keep our hotels open, because there's a cost involved in security, maintenance, and general upkeep. So I'm hoping that we can now maybe look at even reopening some more hotels based on what the programs currently are.
Yeah, Dee, just in addition to that, and I've seen a couple of questions flash across the screen about the wage subsidy, because it just came out yesterday and it's fresh news. The program, so I'll tell you what I know. The program gets backdated to March the 15th. It's for a 3-month period. And I saw one question about the 30% loss in business. seems almost certain that for March 15th to April 15th, that we will be off 30% and across the industry, or considerably more than that. It seems reasonable that even in the second month of this program, you would still qualify. Hopefully we don't qualify in the third month and we don't need it for the third month, but it's there if we do need it. So it's a 3-month program backdated to March the 15th. You keep your employees on, and I assume there'll be some way to recoup the money down the road.
Okay, great. And along the same lines, just in terms of, the decision to close hotels, I think one of the things that we're starting to see is we're starting to see the beginnings of initial wave of alternate uses for hotels through negotiated agreements with various municipalities or provincial agencies, where hotels are going to be utilized for first responders, medical personnel, and quarantine centers. What has been your experience with that, George, Kenny, Deepak?
From Sunray's perspective, we've been working closely with the public health to assess what needs may be out there for those types of things. We have been for the last 2 or 3 weeks contacting hospitals for healthcare workers and first responders that are working on the front line and don't necessarily want to leave their place of work, the hospital or the clinic, and go home. So we're finding some traction in working with the hospitals in order to capture some of that business kind of broadly. I think that there's still news at 11 as it relates to the need for alternate type of facilities to care for some of these folks. So it's certainly evolving pretty rapidly. And again, I think it's going to evolve more over the next 2 to 3 weeks.
Yeah, we have one hotel in Montreal that we currently have hospital patients in. We have signed a deal for 4 more hotels in Ontario. I'm not sure that we have any patients in those hotels yet, but as the spike in patients come to the hospitals, we expect we do expect over the next 2 weeks to have patients in those hotels as well.
We are seeing some scattered demand from hospitals and some airline who are paying for their own account. So, can you hear me?
Yeah, Dee, we can hear you.
Okay. So we're seeing some scattered demand. Nothing significant has materialized yet, but we know of hotels which are being taken over by Health Canada, fully booked for airline passengers arriving. But I suspect that will probably disappear in 4 weeks from now, right? So hopefully we get additional health frontline workers related business. Nothing much yet.
Okay. Great. We're getting a fair amount of, I've gotten some direct emails about some questions around the lending environment. So let's shift our discussion to that if we can for a few minutes. And, one of the questions that has been posed is what's the environment now? Are lenders actively looking at financing? Mark, do you want to start that off?
Sure. So we canvassed our institutions across Canada to understand more or less who's in, who's out, and the new lending parameters. I would say around 2/3 of the institutions today are a bit of a pause mode until there's further clarity. 1/3 of the institutions are indicating that they are open for business. The key component is going to be to get an updated appraisal, even if it's just a month old pre-COVID, to understand how the effects of COVID would be affecting the hotel through a construction loan or a term loan. But there seems to be some support. Number 2 is the dynamics are changing in terms of debt structure. There's been a little more focus on the guarantee aspect and liquidity. Obviously, there's a time that we need the liquidity. So as the depth of liquidity or capacity for a borrower to support a hotel loan during these times, if you will. And also from a lending perspective, as of a month ago, we have never seen such a more liquid debt market since the mid-'80s. And therefore a little more aggression was coming in terms of higher loan to values, longer amortizations, a more non-recourse was taking place. I think that paradigm has now shifted and looking at a little more slightly conservative loan to values until we stabilize.
And for the owners on this panel, what is, I know we talked about your experience with lenders, and I think for the most part it has been positive. But is there any discussion? Or do you have any ongoing applications with lenders, and how are they dealing with that?
I can maybe answer that one. We currently have one application which was approved for funding. Again, it was based on a pretty low loan-to-value ratio. I think that's one of the reasons. But you have to keep in mind that right now the focus is on liquidity and preservation of your capital, right? For anybody to try and say there's liquidity available, I think unless it's an exceptional basis, until we know where this thing ends up at. The spreads on the markets are pretty wide right now. So even to try and borrow money, I think it's going to cost you more. So you're better to wait maybe 60, 90 days and look at liquidity from that point of view. I think to try and borrow in today's market condition, it would not be wise, because you'd be spending higher spreads. It is available on a case-by-case basis, I think, and maybe Mark can probably answer to that more.
Yeah, sure. Thank you, Deepak. And I would echo Deepak's position. The lending spread right now has increased across the board from a minimum of 50 basis points increase to as high as 200. Now, 50 basis points increase, you can get rates at mid threes, but I'm talking maybe the first 10, 15 percentile of the institutions. A good portion of the institutions, especially the credit union market, used to mirror the Government of Canada bond when quoting a fixed rate for 5 years or 7 years. The issue is, due to the uncertainty in the market and the volatility, the cost of capital has increased for all institutions. And a lot of credit unions rely on the deposit and different mechanisms for cost of funds. And their rates are now shooting up to 4s and 5s across the board. So there's a big variance from mid 3s to mid 5s at any given for 5 or 5 year term loan. For construction loans, the same thing. If we had a prime plus a half or prime plus 1, it's now prime plus 1.5, prime plus 2. So again, you have to wait it out. If you have a very strong project, strong hotelier, good urban market hotel, and you have an approval in place, then yeah, maybe you can lock in for the mid 3s. But for the majority, it's a bit maybe a good time to wait.
Yeah, I would agree with Deepak as well. We are not in the market right now looking for any refinancing. We otherwise would have been. Without this crisis, we would have started by now working on some debt that's due in late to Q3, early Q4. Our strategy for those is to seek a short-term extension with our existing lender to get us past this crisis into 2021, and when the market stabilizes again, and then work on refinancing then.
And one more comment regarding construction loans. Sorry, regarding construction loans. We're getting a sense that if a project is being opened in the 14th month, 16th month from now, there is an appetite for institutions looking to participate today, because it's more of a short-term issue. And so again, we would get an updated feasibility, get an outlook of from a feasibility and appraisal standpoint with post-COVID, but there is a bit of appetite on the construction side.
Alan, there was a question about the $1,000 per month per room clarity. Our calculation includes fixed cost, which is heat, light, power, insurance minimum, security cost, fixed contracts, which we have, some franchise-related cost in there, principal, interest, and mortgage. So if you deduct that principal and property taxes, you could come down to 700, 600, depending on what your debt is. So that's the clarity on the number. So it includes all your fixed costs, all your contracts, fixed contracts, which you cannot get out of yet. We are negotiating most of them, but that's basically the sort of guideline between 1,000 to 1,200, including principal, interest, and property tax. Okay,
thank you for clarifying that, Dee. Just jumping back to George, there's a question, just given your portfolio, I think there's a question related to what is your experience with insurance companies? And I know that you have a certain amount of debt with US-based insurance companies.
Yeah, they're having the same experience in the US as we are having here. The larger US insurance companies typically aren't up in Canada in a big way. They tend to want urban assets in the major Canadian cities only. So we do have loans with 3 of the large US life insurance companies. They're once again have been very cooperative and supportive. They just have a much more formal process. In fact, we had to sign a pre-negotiation letter with each of our 3 life insurance company lenders, just to start having the discussions where sort of the rules of engagement of the negotiation are all sort of very laid out. And this seems to be their process, which is fine. But we do expect to get a 3-month principal holiday from all 3 of those lenders.
Great, thank you. I think the other questions that are being posed, George, again, not picking on you, but there's another question about your recent financing of the Royal York, and you don't necessarily have to specifically talk about the Royal York. I think the question is more related to larger hotels and how you're coping with the cost containment on those hotels, and specifically dealing with the lenders.
Listen, we have closed some of our larger hotels that have been managed by Fairmont and Accor. The Royal York right now is operating with a skeletal staff, keeping their costs as low as possible. My understanding, and we're a minority partner in that hotel. KingSett is the largest partner and asset manages it for the partnership. My understanding is right now they don't intend to close the hotel. And that they intend to just run it as skinny from a staffing standpoint as they can. And there is still some business around, a lot related to COVID. And with the number of hotels that have already closed in Toronto, there probably is enough business to keep the Royal York going with the skeletal staff.
That's great, thank you. Dee, do you want to shed some light on your experience with some of your larger hotels?
Yeah, I mean, clearly, if you look at our large hotel, the Hilton Toronto Airport, are probably the biggest box we have. We're still open there, and we have some airline crews in there, and we are getting some passengers coming in self-quarantining in there. And so we kept that open because the payroll is the business is enough to meet the payroll, and the costs are high, and we're trying to contain it. That would fit into that 12 to 1,400 per month per room to carry for the next 60 days. So the bigger boxes are challenging, but hopefully this is only a short term. I think we're looking at 60, 90 days, and then hopefully turn it back around. A couple of things, Alan. A question about assistance and availability of programs. I think if everybody goes on the Hotel Association website, all of that is posted there, or they can call HEC directly and get lot more information is posted there. So for people who are looking for information on potential liquidity, whether it's BTC program or Government of Canada program through the banks, the employee program, it's all posted by HEC on their website, and you can reach out to them for that information. Pretty good information. They've done a pretty good job of it. We keep talking about this. I think we should maybe talk about potential. What is the next step after this is over? And how are we dealing with our brands, and what is going forward? We've talked about arresting the issues, giving information to lenders and stakeholders, but then the next question should be recovery mode. How are we going to recover? What are we planning to go from here? Whether it is a recovery of having your financing due in August or January 21, and how are you going to deal with that? How are you going to deal with business? How are you going to deal with your brands and all that? So maybe you may want to pose a question on that.
Perfect segue. That was a brilliant introduction. So why don't you start, Dee? Let's talk about the recovery, because I think it's something that obviously we had collectively talked about, and I think it is important. And so perhaps you and the rest of the panel can shed some light on that.
So once we have our operation team focused on arresting the problem and liquidity and looking at hotel openings and closing, we have few members who are now looking at how we're going to get a recover going forward. And we have some marketing team and sales team are now getting together to look at that. We think this is probably a great opportunity time to work with your brands and leverage their different loyalty memberships that they have, and get them to help us with the relaunching of the marketing and getting back into business quickly. I think if we utilize that, and then start up direct marketing to travelers, which you already had before. And one asset you have is your data. Utilize that to reach out to everybody. And I think we need to start focusing on businesses which we have lost and trying to bring them back, and then trying to see what else is out there. And then until the European market or the American markets open, I think we need to focus on the Canadian markets, Canadian travel. Hopefully from June, July, August, whenever this happens. So that's what we are focused on, is also focusing, making sure that we are not forgetting that we have a business to run 3 months from now, 6 months from now, and 12 months from now. That includes sales, includes financing issues and branding issues.
Great. Kenny, did you want to add anything to that?
Sure. Some things to consider. I agree with Dee wholeheartedly. Today, if I kind of look at it today, what's happening and then what's going to happen in the future. So today, it seems like everybody's focused on cost containment, cost reductions, and that kind of thing. And that's what we've been doing for a couple of weeks now, if not longer. The preservation of capital and having liquidity, as we've all kind of recognized, is important. As we go through these relief programs, at some point, we're going to have to start paying that back. So the preservation of capital is going to be important, but we don't get into another cash crunch once we come out of this and we're in that period in trying to grow our business going forward. And I think the other piece to this is we centralized our sales and marketing pretty much in our Toronto office. And we're starting to plan, whether it be sales and marketing campaigns, social media messages for when we come out of this into the third and fourth quarter. Because if we just focus on today, we're not minding the store going forward when this passes in the next few months. Alan?
Great. George, did you have anything to add on that?
No, I think that's. I think they've touched on it. Other than our salespeople continue to work and to sell, for later in the year. So we're not slowing down our sales efforts at all.
One thing I would really urge whoever is listening and is to contact the member of parliament, get employees to write in to see how we can get support from marketing dollars from the government of Canada for tourism-related matters for go-forward basis. I think we need to lobby for an incredible budget for that as well. We should not forget that. And I'm sure HEC is doing it, SUS is doing it, but I think if we all write in to different stakeholders and to try and get support for marketing beyond July 2020.
So I agree with Dee on that. One of the things that we're kind of cognizant of or mindful of is, as all of us are painfully finding out, it's kind of hard to stay at home and kind of self-isolate. I think that after the travel restrictions are loosened a bit, there's a huge amount of pent-up demand where Canadians are going to start traveling in Canada. It's somewhat ironic that we're seeing very, very low price of gas at the pumps and nobody's traveling. If that holds, I see more Canadians taking shorter trips and more often trips, and I think there's some pent-up demand coming when we come out of the travel restriction loosening.
I think, Alan, that speaks to what I was saying earlier about a V-shaped recovery. There's been so many events deferred into the third and fourth quarter. If the virus is contained or more contained at that point, there's a tremendous amount of pent-up demand. And so, I do think it could potentially be a sharp recovery.
Yeah, the other thing to keep in mind, kind of post 9/11, post SARS, hotel new supply was constrained. I suspect that this will have the same impact over the next year or so. So that's one benefit to this as we go forward. To your point, Brian, as it relates to a V-shaped recovery. So I firmly believe that new supply is going to be more constrained than it has been in the last couple of years.
We heard some interesting stats just in terms of the supply chain coming out of China. 90% of all the doorknobs in the world are manufactured in China. So if you're trying to complete a hotel and open up a hotel, just physically doing that is going to be challenging. So certainly when we're looking at markets, we're seeing the likelihood that some of the new supply opening will get pushed out.
Yeah, just to add to Kenny's point, I don't think that we can underestimate the benefit of the low gasoline prices moving into the summer months. If they stay even close to where they are now, people will get out and travel. Historically, we've seen that. We've seen them stop traveling when gas prices have been high, and we've seen them travel when gas prices have been low. So I think we shouldn't underestimate the benefit for this busy summer months that we could get from low gas prices.
Well, the other thing that I'm looking at in terms of the stats, I mean, there's no question that the international and US markets are a big piece of the market in Canada, but we're still, an 80% domestic market. And we could be looking at a summer season where the virus is not contained to the same degree in the US as it is in Canada. So we may feel a certain level of safety traveling within Canada, but the borders may not be open freely. So really focusing the efforts on the Canadian traveler, I think, is going to be important.
Great, thank you. And I think that kind of supports what Mark has been talking about, which is really the supporting the feasibility studies. I wasn't going to let Brian and Kerry off the hook on that because Mark talked about doing feasibility studies in this environment. So I think those are all things that can certainly help support positive studies. Notwithstanding the fact that we've talked about supply being curtailed.
Yeah, I mean, you can see a lot of questions coming up in the chat box in the Q&A about how you project in these markets. I'm sure Brian feels the same way. We wish we had a perfect crystal ball. The only thing any of us are doing forecasting, we know that we're going to be wrong to some degree. But we've always come out of these cycles. The pace that we come out of them is somewhat dependent on the depth and how many different sectors of the market are impacted. So we're basically doing, I wouldn't say week to week forecasts right now, but certainly internally we're doing month to month forecasts and modeling, what do we expect the second quarter this year to look like, third quarter, fourth quarter, and how quickly can we rebound from where we go down to as a low point.
I want to comment, go ahead, Deepak. I just want to comment on Deepak's earlier point in terms of maturities coming up. It's a great question. It's a good statement because the maturities are coming up. I think it's very important to understand that all hoteliers, there are options in the market. So the first thing to do is to obviously talk to your current institution. If we're right in the thick of it with no clear direction, then maybe ask for an extension. If the extension is given and they find the portfolio is full, there are options out there. So it's worthwhile to explore those options. Number two is with the current interest rate environment, it's a wide variance, again, from 3.5% to 5.5%, depending on the cost of capital. Also, depending on the new lending parameters that may come out post-COVID, is that going to meet your investment horizon and also your working capital requirements, depending on the leverage that you would receive. So again, maybe worthwhile to explore what's going on, but start with your institution first.
Mark, the other question that's come up is, and we've talked about deferrals of principal and interest. What are the bank's position on ratios such as your coverage ratios?
For this year, so I think majority of the consensus right now, for this year, no one's going to meet their debt service coverage ratio, so it's going to be pretty lenient. I think they're going to waive that covenant, and I think under BDC's application, reading it through, when you're applying for the $2 million, they also want an acknowledgement from the current institution in place holding the first that again they're going to acknowledge that the covenant is not going to be met. And then again, of course, going forward, depending on the hotelier's projection, coupled with, again, the feasibility or appraisal projections and where the market's going to be, they may be adjusted accordingly. Again, we're right in the thick of it, so to be seen.
I think that's a good point. As Mark said, we're in the thick of it, and people do ask questions. Where do we see values? But effectively, and you can probably speak to this yourself. we're in a bit of a non-market. You know, I don't think we're seeing really any transaction activity. You know, anything that was in progress has been put on hold. New offerings have been held back. I mean, I think there's certainly buyers out there that would love to, you know, buy at a you know, a bargain price, but you know, I certainly don't think there are too many sellers at that kind of pricing in this market. And again, I do think longer term, you know, the prospects are still very good. But just curious from your perspective, from an investment standpoint, how you're seeing it.
Yeah, I think it, you know, it really is a function of how far the transactions, you know, what stage you're at in the transaction. So, you know, those deals that are still in a conditional period, for the most part, we're seeing borrowers or buyers actually asking for extensions because obviously, you know, they've focused on trying to buy that asset, so they want to try and, you know, maintain that. So we're seeing that in majority of the cases, sellers are agreeing to extensions. And then you've got obviously situations where you've got transactions that are in a firm position with non-refundable deposit. Those tend to be a little more tricky to deal with. And you know, there's the obvious options are, you know, either repricing it or frankly walking away from the transaction. So thankfully we haven't seen anyone walk away from non-refundable deposits, but I think the argument for repricing is definitely something that a lot of people are making.
And Alan, to your point as well, for the commitment letters that are firm, again, just to recap, the majority of the institutions are honoring the commitment letters and closing and acknowledging the fact that the cash flow is not there the next day and they're providing the interest only. Not all, but most are acknowledging, which helps supports that purchase.
Alan, there's a question about if this thing lasts longer. I'll just share my views with whoever wants to listen, is that we're budgeting a zero-based income for next 60 to 90 days. So we budgeted, assuming that this thing lasts for 60 to 90 days. And then to try and budget for the next 12 months thereafter, we've taken a view of, on an annualized basis, about 52% occupancy, and the rate to be maybe 15 to 20% lower than our peak rate was. And the rationale behind that is very simple. As much as the domestic travel may happen, all that, until the global economy comes out of it completely, which we don't know, America has to come out of this event, Europe has to come out of this event, India, China, they have to come out of this event. So there's a lot of external factors still out there beside the virus. I think so until all those factors start to come back together, my view, just in our company's view, is that we should not budget more than 50, 55% occupancy and try and survive based on that occupancies and make sure that you communicate that to your stakeholders, especially lenders, because there are covenants there for debt coverage ratios and all that stuff in there. So we need to communicate to them to make sure, based on our forecast, and they may change up or down, that being open and transparent with our stakeholders. I think that's the way that's the way we are planning anyway, so that that we can come out of it okay at the end of the day. And it may take 18 months before we're fully there. So that's our view anyway.
Thanks, Dee. Anything that Kenny and George, you want to add to that?
No, I think
in terms of your views on forecasting.
No, we're pretty well in the same position as Deepak, so we have similar views. I think that we're, you know, again, we're going to try to hold the line a little bit more firmly on rates. You know, I think that once North America kind of gets through and travel restrictions are lifted, the weaker Canadian dollar certainly helps Canadians stay in Canada and travel in Canada. And if the restrictions get loosened a bit as it relates to U.S. travel, it becomes pretty doggone cheap for people from the U.S. to travel to Canada, although I think that's a ways away.
Yeah, Alan, we've run 3 scenarios for all of our hotels. A best case scenario, which is sort of a 30 to 60 day down cycle, a most likely case, which is a bit longer, and then a downside case, which this crisis goes into the fall. We're hoping for the best, obviously, like everybody, but we are planning for the downside, so that if the downside happens, that we can still come out of the other side.
So one of the other questions, and we talked about deferrals and some of the fixed costs. One of the questions that has come up relates to property taxes, realty taxes. I know that it may vary from region to region and municipality to municipality, but what are you guys doing on deferral or not paying your property taxes?
Well, I think the city of Brampton, for example, came out with a 5 month deferral on property taxes, right? So each municipality is different. City of Toronto, I think, is 2 months or 3 months. I'm not sure, but every municipality has got a different set of guidelines for deferring property taxes without penalties. So I think you just have to go to your different municipality website and check what's available.
Yeah, I would agree with that. If there is some concessions given municipality by municipality, obviously take advantage of them. Other than that, if they're not giving concessions, we all know what the interest rate is on unpaid property taxes. I think our lenders would appreciate that we keep them current, subject to any municipalities giving some grace. So we plan to take advantage where we can and keep our property taxes current otherwise.
Were there any other questions that, and this is a question to the members of the panel that you saw in the chat that you want to address? I think we are nearing the 1 hour mark, and I think we've got the capacity to go on for a bit, but wanted to know if there's any specific questions you saw in the chat that you wanted to address.
Alan, I think I'm assuming because we're recording this, we can also go back to these questions because there's quite a number of them, which is great. And follow up afterwards, clean up some of the questions directly with some of the members who joined.
Yeah, certainly. I think there are a number of questions in there that will, that are very specific, and I think it's certainly our intention to try and address all those questions later on. One other thing I should mention is that we are recording this, and we'll be sending out a link to everyone. So for those people that that didn't register or weren't able to register, please feel free to share that link with them. We're hoping to get that out hopefully by latest by Thursday, as soon as we've got that pulled together. At this time, what I'd like to do, and I think you all commented on what the work that HAC is doing and the resource that HAC has provided to the industry. I think that is something that I think would be very useful for members of the industry. I also want to take this opportunity to acknowledge the coming together of the Canadian Hotel Advisor Collective, which was jointly formed by Blake Castles Graydon, Castles Rock Blackwell, CBRE Hotels, CFO Capital, Colliers Hotels, Cushman of Wakefield, HVS, and JLL. This advisor collective was formed in response to COVID to act as a centralized source to filter, funnel, and direct timely information for industry stakeholders. This is something that we're hoping is going to be a resource in addition to all the good work that HAC is doing. Unless there are any other questions at this time, I'd like to acknowledge the contribution of the panel. Your insight and guidance has been invaluable. It's great to hear that you all believe in the strength and resilience of our industry. And though we are in for a bit of a rough ride, we know the industry will do what it has always done, which is face this challenge head on and come out stronger for it. I want to take this time to thank you all again for all the participants for dialing in, and to the panel members, thank you once again, and be well.
Thank you.
Thank you.
Thank you, Alan.
Thank you.
Thank you.